The same week, the most important question in the market got an emphatic yes. The market fell apart. Micron reported a blowout and the stock jumped about 17%. The artificial intelligence build is earning its return. That part is now audited. And on the very same tape, Korea's main stock index, the Kospi, fell almost 6% and tripped its fifth market-wide circuit breaker of the year. A record print on one side, a global unwind on the other. That contradiction is the whole story. Here's why they happen together. The Federal Reserve's preferred inflation gauge just accelerated to 4.1%, the fastest pace in 3 years, and the rate cut cushion the whole market was leaning on is gone. Where did that inflation come from? Look at the same memory shortage that minted Micron's record margin. Apple just raised prices on every Mac, iPad, home device, and the Vision Pro to cover it. The boom that prints the chipmaker's margin is the cost push that lands in the inflation number. The boom is building its own break. So where's the edge? You separate what owns pricing power from what is short the discount rate. This is not the market doubting artificial intelligence. Micron audited the demand. It is the market repricing for the inflation that demand creates. Own the input that prices the boom and the cash machine that funds itself. Be wary of the assembler eating the cost, and the leverage the inflation keeps repricing lower. The crowd traded the headline. The evidence reads the circuit. This is the asymmetric. Issue 28, the Unwind, Tech and Crypto Investing for Thoughtful Retail from an Operator's Lens. Last issue resolved the narrow question. Micron's record print proved the artificial intelligence build earns its return. This issue names the force that kept re-rating everything else on the same tape. And the name is uncomfortable. The boom is building its own break. Here's the one-line read. The Unwind has a single engine, and it is inflation the artificial intelligence build itself creates. On May data released the 25th, the Federal Reserve's preferred inflation gauge accelerated to 4.1%, the highest in 3 years, removing the rate cut cushion the whole complex relies on. The mechanism is visible. Apple raised prices on all Macs, iPads, home devices, and the Vision Pro to counter the memory shortage, and fell about 6%, dragging the Nasdaq to a fourth straight down day, even as Micron jumped about 17% on a blowout print. The repricing went global. Korea's main index fell almost 6% and tripped its fifth circuit breaker of the year. The discount rate hit every non-yielding asset at once. Bitcoin broke below $59,000, its lowest since late 2024. Strategy's flagship preferred sat 26% below par, and the exit window cracked. OpenAI is reportedly delaying its public listing to 2027, sending SoftBank down 12%. This is not the market doubting artificial intelligence demand. It is the market repricing for the inflation that demand creates. You'll see the same labels throughout. Confidence, high, medium, or low. Consensus versus variant, what the market believes and where we may differ. And on every call, what would change our mind. That's the discipline. Part 1, the macro regime. The boom builds its own break. The 30-second frame. 1. The engine is inflation the artificial intelligence build creates. The inflation gauge accelerated to 4.1%, the hottest in 3 years, removing the rate cut cushion. 2. The transmission belt is visible. Apple raised prices on every Mac, iPad, home device, and the Vision Pro to offset the memory shortage. Gadget prices rising is the rare goods inflation signal. 3. The Unwind went global. Korea tripped its fifth circuit breaker of the year, and the Nasdaq logged a fourth straight down day even as Micron jumped about 17%, because Apple, not the memory makers, led it lower. 4. The leverage and exit layers cracked Bitcoin below 59,000. Strategies preferred 26% below par, and OpenAI's listing slipping to 2027. And 5. The offset is oil. Crude fell to pre-conflict levels as the Strait of Hormuz reopens, the one real disinflationary counter, and the reason the 10-year yield slipped below 4.5%. Start with the engine. On May data released the 25th, the Federal Reserve's preferred inflation gauge rose to 4.1%, up from 3.8% in April, the highest since April 2023, the fastest pace in 3 years. The core reading rose to 3.4%, the highest since October 2023. The gauge is accelerating, not cooling. Every prior issue's split, cash flows confirmed on one side, valuations and leverage derating on the other, runs through a single variable, the discount rate. A 4.1 print is the cleanest possible confirmation that the rate cut cushion stays far away. The crowd read the Micron blowout as the all clear. The tape read the inflation print as the all stop. The hot number raises the opportunity cost of every non-yielding and leveraged asset at once, work no single company's earnings can undo. Now the transmission belt, how the memory boom becomes goods inflation. Apple raised prices on all Macs, iPads, home devices, and the Vision Pro explicitly to counter the memory component shortage. The stock fell about 6% and led the Nasdaq to its first four-session decline since February, even as Micron rose about 17% on record earnings. Here is the whole issue in one fact. Micron's record gross margin of nearly 85% is the supplier side of a memory shortage. Apple's price hikes are the demand side of the same shortage reaching the consumer. The supercycle the bulls celebrate as proof the build pays is, at the macro level, a cost-push inflation impulse, and Apple, the most pricing-powered hardware brand on Earth, is the channel through which it lands in the inflation basket. The boom and the break are the same machine. Three forces, one slide. First, the exit window cracks. SoftBank fell about 12% after a report that OpenAI is leaning to delay its public listing to 2027. SoftBank has roughly $65 billion in OpenAI, a $40 billion bridge loan due in 2027, and a margin loan against the stake that's stalled. SpaceX's recent bond trades at paper losses. When the rate is rising, the entity that must raise capital to keep building is exactly the one that gets squeezed. Second, the Unwind went global. Korea's main index fell almost 6% and triggered its fifth market-wide circuit breaker of the year, with Samsung and SK Hynix each down more than 9%. Third, the offset is oil. Crude fell almost 4% to pre-conflict levels as the Strait of Hormuz reopens, pulling the 10-year yield below 4.5%. The bull case, oil-led disinflation, is a faster, broader force than the narrow memory cost push. Is the Federal Reserve fighting yesterday's inflation? The next inflation print is the referee. Part 2, In Focus, the cleanest transmission belt in the tape. The In Focus name is Apple, pulled live from the filings. For its fiscal second quarter, the quarter ended in late March, Apple reported $111.2 billion of revenue and $54.8 billion of gross profit. That's a gross margin of about 49.3%, record territory, up from about 46.9% for the full prior fiscal year. So Apple sits at a record margin and is raising prices. That is the choice. Defend the margin by passing the memory cost straight to the consumer rather than absorbing it. Apple is the price taker on memory, now defending a record margin by hiking into a softening consumer, which is exactly how the artificial intelligence memory boom becomes the goods inflation that keeps the Federal Reserve hawkish and the discount rate high. Now the mechanism, the circuit stage by stage. Stage 1, the memory shortage. Micron's record gross margin of nearly 85% on sold-out high-bandwidth memory is the supplier capturing a real structural shortage. The input layer owns the pricing power. Stage 2, Apple hikes. The price taker defends a record 49% margin by passing the memory cost straight to the consumer, raising prices on every Mac, iPad, home device. And Vision Pro, the assembler eats the cost. Stage 3, the inflation print. Gadget prices rising is the rare goods inflation signal. It lands in the basket, prints 4.1%, keeps the discount rate high, and the high rate unwinds the artificial intelligence, crypto, and leverage complex. The asymmetry, this is not the market doubting demand. The same boom that mints the input's margin is the cost push that keeps the rate high enough to unwind everything short of that rate. The debate, the bull, Apple is one of the few brands on Earth that can pass a cost shock straight to the consumer and hold a record 49% margin. The shortage is the supplier's problem to price. Apple sources it, marks it up, and the customer pays. The assembler with brand pricing power is insulated where commodity makers are not. If units hold through the hike, Apple proves the cost push doesn't dent its economics. The bear. And it's real. A price hike into a softening consumer is a volume risk. Apple fell about 6% the day the hikes hit, So the market's first vote was on demand, not margin. Apple is the price taker on memory. It does not control the input cost. And the gadget price inflation it creates is the very signal feeding the hawkish print that pressures its own multiple. It is short the discount rate it helps raise. The referee is next quarter's units and average selling price. The read, a research view, not a call. Apple is the cleanest illustration of the whole regime. The transmission belt that turns the memory boom into consumer inflation, and the filings make it concrete, a record 49% gross margin, defended by raising prices rather than absorbing the cost. The asymmetric point is not buy Apple or sell Apple. It is the spread, own the layer with pricing power over its customers, the sold-out input. Be wary of the layer absorbing the cost into a consumer the same inflation is squeezing the assembler, and avoid the layer short the discount rate the whole circuit raises the leverage. What would change the read? Next quarter's units holding through the price hikes, the bull pricing power wins, versus a volume-driven guide down, the bear, the hike breaks demand. Memory spot prices rolling over would relieve both sides at once. The countercurrent, the leverage layer the inflation keeps repricing. Bitcoin broke below $59,000, its lowest since late 2024, and more than 50% below its all-time high from last October. Ether sits near multi-year lows, and Strategy's flagship preferred, ticker STRC, trades at $73.62, 26% below the $100 level it was engineered to hold, while the company holds more than 846,000 Bitcoin and sold a token amount in late May. The forced seller channel is ajar, but read it correctly. This is a discount trait derating, not a thesis break. A preferred trading below par is the market questioning the perpetual bid treasury model as liquidity tightens, not a verdict on Bitcoin's long-run case. And the one corner that decoupled is real-world asset tokenization, where the rails kept growing fundamentals even as token prices bled. Own the asset or the cash-generative rails, not the reflexive lever. And the thematic separate what owns pricing power from what is short the rate. The unwind is not the market doubting artificial intelligence. Micron audited the demand. It is the market repricing for the inflation that demand creates, and the assets being punished are the ones that need a falling discount rate to work. So own the input that prices the boom, the sold-out memory with pricing power, the scarce profitable power and baseload, the toll booth that already prints cash. Own the self-funding cash machine, the hyperscaler that funds the biggest build on Earth from operating cash flow, and the proprietary data compounder whose margin doesn't reset with a commodity cycle. Be wary of the assembler that eats the cost, the price taker passing it into a softening consumer. And be wary of what is short the discount rate, the exit liquidity-dependent private artificial intelligence complex, and the reflexive crypto lever. The discipline that survives an unwind is altitude. Part 3, the unwind. The boom is building its own break. What we are watching over the next 10 days, the next inflation print, the resolver of the whole unwind. Hot keeps the discount rate engine running, cool lets risk assets re-rate. The Korea and Asia Open, does the Fifth Circuit breaker stabilize or cascade into a sixth? The artificial intelligence listing pipeline, confirmation or denial of the open AI delay, and any marquee deal pricing that tells you whether the exit window is closing or reopening. Strategy, any official response. A forced seller headline is the crypto contagion trigger. Apple's units and next guide, whether the price hikes hold volume. Oil and the Strait of Hormuz, whether crude holds its de-escalation lows. The 10-year yield below 4.5%, the relief tell. And memory spot prices, a rollover relieves both the input margin and Apple's cost push at once. And we keep score in public. Apple enters as the squeezed transmission belt, a record 49% margin defended by raising prices. Watch whether units hold. The macro engine, a discount rate derating that runs until inflation rolls over. Artificial intelligence exit liquidity tightening, owns self-funding over exit dependent. Crypto bifurcation, the leverage derates while the rails compound. Micron, own the sold-out input, respect the cycle. Zeta Global, the durable margin software compounder. Alphabet, the self-funding compounder. Constellation Energy, the power bottleneck. And gold, constructive structurally, pressed near term, cited by level and driver, never a contested return. dated, falsifiable calls, and we grade them. So where does it land? The Micron blowout and the global unwind are not a contradiction. They are the same fact read at two altitudes. At the company level, the build pays. Micron's margins are audited, its memory sold out. At the system level, that very boom is a cost-push inflation impulse. Apple is passing it to consumers. The inflation gauge printed 4.1%, and the Federal Reserve stays hawkish. High discount rate that follows is unwinding everything that needs a falling rate to work. The most crowded equity trade, the leverage layer, and the exit liquidity-dependent private artificial intelligence complex. The discipline that survives an unwind is altitude. Separate the layer that owns pricing power from the layer that is short the discount rate. The crowd traded the headline. The evidence reads the circuit, and the circuit says the boom is building its own break. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.